started on time at 10:16. We did a drawing. 2 people were not in the room. One person won, though, $150 cash or a Visa card. So you might want to get back in the room on time. Just an FYI. All right, Delali is going to kick off our risk session along with Essentia. So we'll let him take it from there.
Yep. Thank you very much. And welcome back. My name is Delali Morte from Emera Energy. I will be thank you, all the way from Halifax, Nova Scotia, Canada. So I will be facilitating the risk session, stepping in for Brandi. Thank you. So we have a few topics. These are just a few we put together. These are not written in stone. So if there's anything that needs to be, asked after or before, that's fine. We can accommodate that. But we're going to start with managing commodity risk. We have our good friend Tom from Essentia, our gold sponsor, who will be doing a presentation, and then we'll pick it up and go through the other topics. So without further ado, I would welcome Tom to give his presentation.
Thanks, Wally. Again, height challenge. Let's see if I can get this there right. Okay, we're good. Welcome. So many of you may know Tom Alaman, former risk manager at Allegro. I used to do all the stuff that works. The stuff that doesn't work, go see Ann. You may also know that I'm a partner at Essentia today. What you may not know is I'm a huge musical theater fan. So we're going to do this little tap number, risk. Anybody? No? No? Okay. Kidding. Volatility. We already talked about volatility. So just to mention a couple of things that have been going on this year. I think this is not news to anybody, but the movements, I used to trade gas way back over, come off to the left about another 10 years before that, and maybe back again in the middle, but this year has been extremely exciting, right? Volatility is unmatched, and it's very important as a part of what you're doing in risk to know and be aware of volatility. But the thing about volatility is that there's sort of background noise volatility. Any people here are, what's the phrase, fans of evolutionary theory? I used to have this professor, and he spent 4 weeks in a biology class, and all I saw were slides of churches, slides of churches, slides of churches, and it was Gothic church, Gothic church, Gothic church. And then one day he says, and then these arches came up, and everything changed dramatically. And his idea on evolution is very much like my thoughts on volatility. There's this background noise, there are things that are happening in the background, but really volatility is event-driven. And so when you have events, things change dramatically, whether it's pipeline blowing up, a mad Russian coming to visit us, or how do I describe it, a candidate came here to visit Houston for a couple of weeks. Whether you have banks going bankrupt every weekend, or if you have an asteroid in the design desert is about to disappear. So the important thing, what do we do when things are event-driven? Now, I was asked to talk about some basic concepts, and so we're going to talk about those things first for PFE. So, show of hands here, how many people today use PFE in Allegro? How many people in here know what PFE is? I got 3. Okay, so you 3 close your ears right now. We're going to go through the basics of that, right?
How many of us want to use it?
Well, that's a good thing. We're going to talk a little bit about that as well. So, basics, 101, credit. Everyone knows or thinks about the idea of credit, and the idea is, hey, I've got a certain amount that I'm going to be collecting from a counterparty who I've sold or delivered product to. And this little step stool there is going through on every day as I'm delivering product. I'm not actually collecting cash unless I'm PJM and charging things 2 days out, right? So as the month goes on, you're collecting, growing. You get to the end of the month, and I'm not doing anything more if I've done a 1-month trade, so it's static. So you get to, if you're gas the 25th of the month, or if your power the 20th, whatever that thing works out to, and hopefully you get paid, your credit risk goes back away. So everybody's kind of comfortable with the idea of, hey, there's a certain receivable amount that I've got as credit risk, right? Words, forget the words. Now, let's extend it out and say, okay, I've not done a single month trade, but we're going to take a 3-month trade. So the difference between the 1-month trade and 3-month trade is that I'm continuing to deliver product without getting paid. So we color-coded things here to make it a little more clear, but you see over there in the far left, our little friendly blue guy, right? That's our first 1 month trade. And then you see that we're continuing to add risk. That's our red for the next month. That drops off, but not all the way down when we get paid. And you're continuing to deliver, and it goes up. And then you have the shark that ate the duck, right? Now, let's take it a little bit different. That's great if things are static, but what if prices move? What if we have an index-based trade? Index-based trades where someone's paying you WTI for your crude or inside FERC or natural gas daily for your gas are usually invisible to risk managers because we say, hey, we're getting paid the same thing that we're getting paid or delivering on the other side, right? So until you get into that month, you're not really thinking about the index-based deals. But this is why you need to be thinking about it, because what's actually happening, or what could happen, is squigglies. You know how I love squigglies. So squigglies are the idea that prices can move, and we've got these basic ideas that prices move on a standard deviation, normal prices, and so we have an expectation day over day that prices change. What we do with PFE is take that same concept and apply it to the idea of our receivable and think about what happens when that price moves over time up until we get paid that product that we've delivered. So let's talk about this. Lots of points here on the other side. If we do a 12-month trade, so there's the same familiar shark concept, right? It's probably what most of our risk managers or credit risk managers are doing today. They don't think a lot about how prices might move. They take a look at the curve today. They project it forward. If they're not looking at the front 60 days, maybe they're looking at the full year, doing something as advanced as looking at the market or doing cash flow analysis, but it's fairly static. What you're doing when you apply the possibility of movement is thinking about how that price could go up over time so that consecutively on payment days at that maximum day, I've got a higher and higher amount as the potential price could go up. It could also go down, but you're applying the same math that you use for VAR, the same theory that you use for price movements, and saying, what would happen if prices moved one direction in favor of that payment that I'm expecting to receive? Now, in practice, if you look at these pieces, the shark tooth, the dips in the shark tooth don't really matter. It's not that they don't matter as much as to say that your maximal exposure is the thing that you're actually worried about. Each of those peaks are the things that you actually care about, right? And so what we do is think about just that maximal period or that maximum due on each of the payment dates, simplify it down to a single curve. So you can compare and say, for my expected exposure, that yellow line, versus my potential exposure, the blue line above it, I have this higher probability or the known statistical probability of a higher receivable due from my counterparty. And now what do you do with that information? The idea is if I were to be an active credit manager, today, post 2012, we're largely collecting margin, we're not thinking about things. So there was a comment earlier, we'd rather not know about PFE. And the reality is for most of our trades, you don't have to worry about it. If you're margining a transaction in real time the next day, your potential exposure is really on that next day or the next 2 days until the margin is due. You realize they're not going to pay you that margin and you close out the trade, close out the mark to market, and it is whatever that difference is, right? But if you've got an asset-based trade, this is still a technique that you have to apply. Or if you are a producer of power, of oil, and you have asset-based trades with your counterparts, they're thinking about the exposure that you create to them the same way. And so you need to apply this tool, number one, know what the risk is, and number two, know and protect that difference. So if I were to do just the bottom piece, then the thing that I'm exposed to is that as prices move over time, I have a gap or I have no exposure. If I'm not margining that trade or thinking about that piece, then I'm open. If I can see it, visualize it, and deal with it, the way that I would deal with it is to buy coverage in the markets. So you buy CDS for that potential future exposure, build that into pricing your origination asset-backed deal, build it into your pricing so that you know that you're charging the right rate for that, and use PFE for that reason. Everybody good? Raise your hands. Everybody know PFE now? Fantastic. So That's models. We've already done this part, right? Who's using it? Who wants to think about using it? If you were to turn on Allegro today, could you go find it in your credit model and turn on PFE? Answer is probably not, unfortunately. So if you look at the screens here that we have as what's available in Allegro, they have a column called PFE, and it used to have a tool called standard deviation, which is that method that I just described. That's no longer supported, that's gone away. What they have is today supported is a conversion factor add-on. This works, but it's a very static piece where it converts the actual amount to a static value, multiplies it through there, runs that through your credit exposure. So what's a credit risk manager to do if they want to use PFE and they want to do it inside Allegro? You have to calculate it outside the system. So we've got solutions that are offered by ION, integrated via FEA, right? I once had somebody here, one of these AUGs tell me FEA is the gold standard. Don't dispute that. I think that's an approach that you could use to use what you want to do. There's a new offering, Allegro ION credit risk, or you could go to a third place and do it. But no matter which of the three solutions you choose, you're going to be writing new code to create that integration between an external model or what you want to do inside Allegro. So one of the things that I want to talk about here is that you do have other tools available to you because of what Allegro offers. So what I described before is that VAR is a fairly close cousin to PFE. The math is largely the same. So as a review for VAR, show of hands again, how many people think about VAR, know about VAR? Okay, so we're much more comfortable with this concept, right? We've got the idea of a statistical known confidence interval. This is my expected loss over some time horizon for my portfolio. You can do it via simulation, as this one shows. You can do it analytically with math pieces, but what you're looking for is that same statistical probability of a price move on the positions that I have, based on what we're doing to look at historical prices to guess what that volatility is or estimate what that volatility is, right? The things that you have in Allegro as tools, parametric VAR, on-collar VAR, and historic VAR. So by show of hands, how many people use all three? Almost no one. So let's go the other way. How many people use analytical VAR? How many people use Monte Carlo VAR? How many people use HIST VAR? So we just lost everybody right there, right? So we use VAR, we're not real sure what we're using. That's absolutely what we'd expect to see, right? It's a VAR, it spits out a number, I don't worry about it, I don't think about it. But you have to think about it, and mostly for your use in credit, it's what does that tool give me that I can use for this other problem that I have that I can't solve with the software out of the box? Words, 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 share back to your credit manager later over here on the right. Shorthand version is the analytic VAR is based on probabilities. We said it's a single number that gives you what the probable move is over a given time horizon. My change that I use for VAR is based on a single one-day move, so it's the square root of 1 over 365, still 1, right? As we move across time or do bigger time steps, that number only grows with that square root of time. So in rough terms, for a 1-month payment date, times 5, 5.5. For a 2-month payment date forward, that's times 8. 3, 9, so forth, to about 1 year is 15. So because you've got that math and that VAR piece available to you, and what Allegro actually does in its valuation detail table is store that VAR detail at the row level, you have the building blocks to compute what your analytic PFE would be to each of the payment dates just by multiplying that VAR number by the square root of time after those payment dates. So if you want to build PFE and you're only running analytic VAR, it's a very small step analytically to give that information over to your credit manager and say, this is what we expect that price could do to each of the delivery dates and payment dates that we have going forward. Similarly, sorry, lost my mic there, HIST VAR. So I don't know how many people were around for when we delivered that first HIST VAR change. That was probably 5 years ago, it was just pre-pandemic, right? So traditionally, HIST VAR looks at the actual prices that you have in a system, computes what that mark-to-market was over whatever time interval you've set. So for instance, many people look at the previous 1 year, 250 business days, or the previous 2 years, 500 business days. And it's running that simulation saying, this is what my mark-to-market might have been, could have been through those pieces, right? Great, throw all that away. What HISVAR as a tool inside Allegro does is provide an API for you to feed in a portfolio, and price history, and or stresses, and it does all the matrix multiplication for you in a big hurry using just delta gamma approximation, so you can get an answer quickly without running a further evaluation. So how do you apply this piece? You use the external tools that are available to you, pull the prices out, feed in, instead of your full trading portfolio, just your portfolio from the credit exposure output in Allegro that you already have. That's the portfolio you feed in. The price history you feed in could be your real prices. You can do a simulation on it, or you could do an actual full simulation outside, NumPy, whatever else you like to use as a tool set, push that back in, and let this thing just do the portfolio crunching for you to give you all the comparisons by counterparty, do party roll-ups, and everything else that you want to do with it. So without spending or doing much more code than you already have to do to integrate to other systems, you've got answers available to you directly from VAR. All that's fine and fun, but at the end of the day, as we mentioned, volatility is an event-driven thing. Price changes are event-driven. If you're using a model, even those models that have sophistication or they call themselves simulations, you're making assumptions about how markets move, and you're missing the big picture. You're missing the asteroid that's going to wipe you out. And so this last section is to talk about what you can do using Allegro simulation tools, because best practices really dictate that you do some combination of model, known statistical confidence intervals, and some amount of testing for black swans, for other events, for things that may happen. Doing the what ifs so that you know what can happen and what can really go wrong. As a risk manager, that's the core question you need to be asking. You know, when you report on VAR, this is what we have going on. This is what could really go wrong with my portfolio. This is how I'm thinking about what it looks like, all these external tools that we've talked about in the earlier pieces of pulling the data out, thinking about 5-minute prices, 10-minute prices, storms. It all comes down to what is that extinction level event that's going to cause a problem for me. And the same thing holds for credit. If you have done all of your hedges with a group of banks, or if you bought big chunks from producers who are suddenly getting negative prices for oil, you have a huge exposure to a sector that will all go extinct simultaneously. Think about that. You have to build in a non-correlated risk to your simulation practices so you're thinking about things the right way. And how you can do this is through that simulation extension. How many people are using simulations in Allegro today? How many people use a 10-day stress, 1-day stress? Almost no one. I think in my experience when I was at Allegro, we saw 2 customers who were using it. They were an airline who I don't see here today, and another one who we call Voldemort because we can never use their name properly. But what we did, and what you can do yourselves, is use this simulation tool to build for event-based risk. Your only limitation with this tool is your imagination. Now, the base tools will let you do static multipliers or large price shifts. You can get more sophisticated about it and think about big correlation moves or directional moves or things that make the front of the curve move much more heavily than the back end of the curve. Any kind of realizations you want. It's just limited by your creativity and thinking about what could go wrong. You don't even have to be that creative. Going back to Uri, going back to Harvey, going back to any large storm that hit the US, you can see that price history if you've kept it, or even if you've archived it off, or if you want to use it again, and build that up as a static price set, and use that as a price shift for your valuation. So one of our customers uses and built that history, Storm Uri, Storm Harvey, Storm whatever. They run through those scenarios on a monthly basis, produce that same set so that they're analyzing their portfolio in a way that's not standard, that's not typical, that tests their assumptions about how things work. Lots of fun stuff on how to use it. Everybody gets the slides afterwards. That's why those pieces are really there. So I don't know how many people are fans of X-Files, but it feels right to reference some 30-year-old television show when we're talking about 30-year-old technology that is PFE, right? So post-2012, as we described, do you need to run back and say, hey, we're doing PFE, I don't know what to do with the PFE, the TSP reports aren't there. No, don't panic about it. I would largely expect that you've got your credit well in hand because you're margining the bulk of your trades. Your term deals, your origination deals, the things that aren't standard are places where you might have unmanaged risk today. Those are the things that are there. And when you think about those pieces, it's important to think about using both models and testing with stresses to get an accurate picture of what that risk looks like. End of the day, Allegro is a great product for you to do that. You don't have to do a lot of other customization. But I just wanted to show you some of the things that you already have in your toolbox today, so you know how to leverage them to better manage your risk. Thank you.
Thank you very much, Tom. That was a lot to unpack there. Most of you are thinking you didn't know you were coming to Allegro University. Any questions about PFE and everything that has been said? Tom said it's a lot of fun. He said we have the slides, so hopefully you can review the slides later on if you have any questions or any. I saw some people taking pictures of the slides. You don't have to. We'll have those available for you later on. But any questions, any thoughts, any comments on that before we move on?
There is no question that is unintelligent or not wanted.
Yeah.
Tom is known, and I can speak from experience, to dumb it down to my level. So please, if there's any question whatsoever, if you really want him to, readdress what PFE is, what is a credit, what is a debit, it doesn't matter. We can take it at any level. So please, this is your time to speak out, because we have a lot of people who probably have questions very similar to what you have.
Yeah, we have some monitoring chat.
We have coffee, so you can, oh, yay.
And can we just ask other questions? If you could just say who you are, where you're from. There was a request that came in earlier.
Jonathan Kreitzer, Program USA. So what kind of configuration is necessary before using the PFE tools in Allegro? Like how much I guess a configuration or setup is necessary to use those more regularly?
So the answer is not much. If you're loading prices in and you're ready, you've got the data that you need. You're loading your trades in, that's there. So the things that feed an analytic bar are calculating a historical volatility. So you need to assign to each of your price indexes a forward mark. You've done that because that's how you accomplish your mark to market. Each of those forward indexes in turn has to have a volatility index associated with it, because Allegro won't let you save that forward index without doing that part. I've seen a lot of people that just say, hey, we want to get through this thing and we're going to put it all as Henry 1. Don't do that. It has to be more complex than that. At least do 5 or 6, maybe a few more. And when you have those pieces in the volatility configuration screen, you say, okay, if I've got a Northeast volatility, I want to associate that with my M3. I've got a Texas volatility, I'm going to associate that with ship channels. So make your picks and set it up to run. There's a volatility correlation worker that you can put as an automated feature that runs before your evaluations or after your evaluations. That part's not really necessarily material. That worker will compute the historical volatility of the prices, and it'll compute the correlations. If you then hit the checkbox in your position mode, hey, I want to run bar, hey, congratulations, you're done, bar's run. Okay? And so again, that just does the basis level of value for you, but it's a very useful level, because what Allegro does in the background is store a unique VAR value for every cash flow in your val detail, with an exposure index, region, all the other things that you want. In that value at risk view, if you've ever used it, you see that when you first select, it spins up and says, I'm thinking. What it's actually doing there is really cool. I love that feature, because there's this complex math that goes on behind. Hey, there's matrix multiplication. We want to think about correlation and how this relates to that and this relates to that. And it does that on the fly right there off those basic values, and gives you, hey, I want to think about using just these trades. What's my VAR if I add in one more trade? And it computes all that on the fly and gives you that uncorrelated risk right there. So with just 3 small steps using the data that you already have, you're ready to go. And then to convert that to the PFE, like I said, it's just a matter of thinking about the dates and then scraping out, divide by 1 and multiply out by 5, 8, whatever you need to do based on that payment date that's also on the record.
Sounds very simple. No, it does. It is. Just yeah. Any other questions? I know a lot of these things. It's once you're into it and doing it, you say, "Oh, this is fun." It's actually fun once you're in it and doing it. When you're just hearing about it, may not be. So if you're into risk, maybe most of you are not. Those who are into risk, if you actually get in the system and try, some of these things, you'd see the benefit of it. So,
Hey, we got a question from online.
Okay.
It says on the analytic PFE, could you also grab the volatility value from the valuation detail and adjust the current market price by volatility and different confidence intervals, trading days to calculate a PFE? That way you aren't limited to the confidence level of your VAR valuation mode. Should we say that's so?
It is not.
You can pretend it is.
No. So, yeah, go back to the beginning. I don't know if we can go back that far. Confidence intervals, what does that mean? We had this nice little normal diagram, right? So confidence interval means, do I want to be living on the fringe, the far, far left of that curve? Or do I want to be living somewhere in the middle part of that curve? What we talk about often with that normal curve, hey, there's this expectation of this, is what we call fat tails. And that's not the duck. That's the idea that things move when events happen. That when things change, they change in a big, big way. You're living far, far out, and it happens more frequently than you would expect. So it says if this natural curve says I've got a 1% probability of being out here, what happens in reality is that probably happens 5% of the time. Well, 5%, that's not that big a deal, right? Well, that means one time a month, you're living out here in that danger zone, in real terms, right? So a confidence interval of 95%, that 5 is saying that 5% is what's industry standard, because we're saying one day a month, I expect to lose or hopefully make that amount of money, right? That's my expectation of my portfolio under normal conditions. We all know that we don't live in normal conditions, but we expect to be out there maybe 2 or 3 times a month. And that when we're out there, we're not right at that level, we're 5, 6, 7 sigmas out from there. So that statistical correlation is math that you could unwind very easily, because it's just multiplication at the end of the day. Divide that back out, and so instead of multiplying times 1.65 or 7 other digits after that to get the 95% confidence interval, I'm going to multiply by 2.3 to get a deeper number. Or I'm going to go out and move that time step out times that square root of time. There's only 2 variables that are moving that price. You've got price, you've got volatility on the record. So once you're there, you can play with it and do the things that you want to do with that analytic set. Heckler.
Heckler. I was kidding. I said I was going to heckle you. I'm not going to. One of the problems I've seen with this approach, what you just described, you're absolutely right. even grabbing a 99% confidence level doesn't do the trick, right? Because people want to know what the worst possible scenario is, given what might happen. And in history, we've had the oil price crash of 2017, 2018. We've had COVID. We've had hurricanes that come in and weather systems and all kinds of things that have happened that cause prices to go crazy. And the reality is, if you're really going to look at VAR, you're right. You probably should dive into it deeper and give a higher confidence level theoretically. But the problem we see with that is when you start prescribing that to a company, that makes the VAR restriction on traders in the trading group much more straight. So how do you address that, or where do you see the compromise?
So right now I'm actually engaged in a project where we're helping somebody write their risk policy. And their risk policy that we came in and looked at didn't look much different from other folks. It was volumetric based, which is fairly static. Hey, this amount, and they have this amount of capital they want to allocate, and that's there. And if you look at it, you can say, okay, the next step up from there is a bar-based piece, but it's not really much more than that same multiplication of math. Hey, if it was 10 lots a day, well, that's times whatever $100 oil plus a $5 one-day adder, that's my new VAR number, and that's my expected change. The problem with these models, or how you'd want to adopt them, is to think about what the return on that expected usage of capital is, and to not give it any more weight in your thinking than that. It's statistics, it's an approach, and it says, hey, I expect this number to happen one day a month. Am I okay with that? Are my shareholders okay with that? If I'm not, if I don't think they would be, then I need to rein it in. But a higher confidence interval or a longer time step is just the same math. So you've still got to explain to your shareholders when you close your eyes to the big event on the other side. And so we recommend always to say, use VAR, no VAR, because it's easy. It's easy to understand because it's one number. Hey, the VAR of my portfolio was $10 million, which, okay, interesting. One day a month I'm going to lose $10 million. Great, we're okay, we're comfortable with that. But the day that I had a $20 million out or a $30 million out, I've still got to go explain that. So I've got to have my stress scenarios to say, this could happen, this may happen. What are the things that we're doing to mitigate those changes? But that standard single number that everybody can understand and look to is important just as a touchstone, because no one wants to play with those squigglies all day long and think about it. And you want to see how that number changes over time when you're managing risk, right? It's not important that my VAR was 10, but I want to know if it's 2, means my traders aren't trading enough, we don't have enough out there, we don't have any ideas. Or if it's 50, we've got too much on the table, we need to pull some back in. And so you should manage that change in VAR more than look at that absolute number of VAR as a risk manager, in my opinion.
That is a great answer. This one I can relate to, and that question, because I'm kind of in the middle of the trading and risk, so I hear from both sides. So thank you very much, Frank. I guess at this point, we can let you take your seat back, and then the users will take this session. Oh, one more question? Okay, sorry, one more question.
One last question came in line, and then we'll have Essentia sit down. Does Allegro have capability of calculating tail end risk, conditional value at risk, in addition to just simple VAR?
I'm going to look at the top and go, you guys built that yet? You ready to go? No.
That was not Jen from Upsell either.
Yeah. The math for conditional value at risk, again, this is kind of angels dancing on the head of a pin. Don't care about those pieces, right? The charge against VAR would be that it's not summative, that it isn't a complete view. There's an approach that looks at component VAR, or an analysis of a single position on the way in, and it's an additive piece, or it thinks about how that portfolio is affected as you go through. And so the math is related, fairly easy to build in even on the transactions or within Allegro. It's not out of the box, but it's not very different from the math that you're already using. It's available in other tools, FEA and so forth, but it's another area that's important. So whether it's there or not is almost immaterial, because the math is a close enough putt where you can get there inside your system, or you can buy a product to do it for you if you don't want to do the math, certify the math, and do all the other steps to go around that piece. I'll go this way.
Thank you very much. All right, so now we will get into the user part of this session, and we'll start with these topics up here, and if anything else we can add to or take from. So P&L attribution. Does anyone have anything nice to say about P&L attribution? Or any questions, or is anyone using P&L attribution in Allegro, or anyone doing it out of Allegro? How you're doing it, how you're integrating? Anything to share? What is P&L attribution?
So, my question to the room is, how many people in a risk group are here? Can you raise your hand if you are in a risk group?
Yeah.
What is your biggest heartache at this point in Allegro? What is it that you wish Allegro would do for you? That's the conversation that we need to have in all these sessions. This is for you to make the product better. So help us out here, folks. I'm not in risk. I can't answer that question for you.
Hey, Brooke, I think a better question is, how many people
What
have
I'm hearing
custom
is Allegro is
solutions?
perfect when it comes to risk.
Can y'all hear my question?
You were saying earlier about who does it in Allegro, or who does externally. I was just going to say ours is externally. We found that the valuation detail views or the P&L attribution views all perform way too slowly given the size of our valuation nightly. It's pulled over into an Azure data lake where we have Power BI sitting on top of all that, and we do full attribution, and we take everything out of fin detail, valuation detail, price. All that information moves over to a data lake on a nightly basis. So.
Okay.
Same.
Okay.
So I do have something to add. Thank you. We do the exact same thing at our company. We extract all the data from Allegro, valuation detail, fin detail, pricing sources. I was wondering, and I think I've seen this before, data visualization tools. When I'm with my analysts, I want to see the data at the most granular detail because I want to be able to explain. But when I am talking to the CEO, I can't use data, right? So I was wondering, are there data visualization tools? I think I've seen them in Allegro, but I don't know how many people use them. I don't know if we just prefer to go the Power BI route. That's actually what we do right now. But that's a question I guess I have for the room.
Quite a bit, a little.
I never knew these. I talked too loud. We get use cases where we've used mainly Tableau. We've got some clients that have investment in Spotfire, and we'll look at that as well. But we've done that, and it's been, I think, largely well received. But to your point, I think typically seeing that Power BI model, just because folks have an Azure stack or just naturally have access to it, is that direction. But I mean, I'd say, probably 4 or 5 use cases of data visualization we've seen on top of risk or data.
Hi, sorry, just to answer your question, I think you're Jeannie. Yeah, I'm Terry from Opportune. I do feel that is the trend when we talk about digital analytics. People aren't expecting it to come out of the ETRM. It's with these third-party software like Alteryx actually, which is I think very undervalued. Tableau, Power BI are very popular. Alteryx is kind of maybe on the more cost-convenient license side, but it's so flexible. Like what we're seeing that it can do as far as even then data cleansing and then maybe pushing it to Power BI or something like that. But I've been noticing a lot more customers ask the question, and I think that's going to be the trend. Like, why customize the ETRM, right, to provide these views when you have these companies or these software platforms that do it way much better?
Allegro does have out-of-the-box tools. To your original question, the decision metrics where you can do like charts and graphs and things like that. For our purposes, we have so many calculations happening downstream in the data lake that it wouldn't really benefit us to do the reporting in Allegro when we have the data that we need downstream. So that's why Power BI.
So I'll just add one other thing, David. Yes, again. One of the other items about the data lake and having that structure and pulling that data externally is we also do not archive like within Allegro. That data lake is our archive of information. We have daily evaluations going back for a couple of years. Within our database itself, we only maintain about 5 days of evaluation detail. So.
Hi, John with Capco. I was just going to say that tomorrow we're going to be presenting with Oxy, and we actually do P&L attribution out of Allegro, but it's a customized solution. So we'll talk a little bit about that tomorrow, just to let you know. And as well, yes. Specific to P&L attribution, we will be talking about that.
Okay, excellent. What we're hearing is those doing this out of the system, especially the presentation of it, right? That's good. Maybe there's a technology question, but how are you connecting your systems? Like Power BI, how are you integrating Power BI and Allegro? What is the or we can leave that for technology. That's
I mean, if you want, I can kind of answer that question. So the way we kind of integrate Power BI with Allegro is we connect Power BI directly to the Allegro database. And so we can extract the data right there and then cleanse it in Power BI and then kind of pivot it to whatever reporting we need to do, all the dashboarding on top of it, and then present that to the, whether it's front office, middle office, or back office.
Is there any performance issue with that? Are you hitting production directly, or?
Yeah, so that's one of the good topics that we've been bringing up lately is if you hit everything directly to the production database, it is a cost, and there is a risk that it might go down, and if production goes down, it's very detrimental to business. So having a reporting server that's parallel to production and having all of the kind of middle office risk analysts to hit the report server for all of their Chat GPT SQL scripts that are not optimized, right? And then anything else that might hit the database.
Yeah, okay, excellent. Thank you. That's, yeah. All right, so anything else for P&L attribution?
No, we have a question online though. I'm not so sure that it's applying to P&L attribution. Maybe somewhat kind of goes in a different direction. And it's probably a question for Ion, actually. How is the integration of Allegro and FEA coming along?
Oh, there we go.
Hello, so my name is Ben from Ion, from Allegro. I'm from France, by the way. I think someone said that.
Love the accent.
So it's actually doing pretty well. So we are kind of done with the option analytics integration. So FEA, it's actually several pieces. One piece is option analytics, so it's the valuation model. So you have your option model summarizing. What we've done is complement that with all the FEA option models, and we built integration with FEA service. So the first task we had to do was to take all the FEA models and move that over servers on Amazon and run the functions. So it's actually can scale. It can scale. So we've done that. It is ready. It's available in all version after 1.5. And we actually built standard class events. So if we modify something to change a little bit the results, then we can do that. Then what we started doing last year was to take the FEA, PFEA engine and valuation engine. So that works plus and created a service for that. Now it's a lot more complex because it's a lot more data, the output is different.
Apparently online is not hearing you well.
Okay. So, and by the way, if anyone is interested, you can contact us. We'll show you what we've done. We have plenty of documentation, so we're happy to share it with you. On the risk works, What we've done is actually to create this service. So that's done, and we're working on a pilot to integrate Allegro with this Risk Work service. The way we're doing it is actually going for, it's not the data lake, it's data bricks from Azure, and it's the same thing. Data bricks is actually like a data lake, but it's a lot more powerful to process large amount of data for Python scripts. So you have access to the Azure data lake, but you have your Python scripts to grab exposure prices from the different places, transform it, and then make the call. And actually, the data we store back into Azure Databricks, we don't even flow the data back into Allegro. As you said, ETRM is good for plenty of things. Reporting is probably not our strength, and we realize that, and that's why on the FU integration, we haven't tried to bring the data back. So it's there, it's in process. Anyone who's interested can talk to me, can contact your account manager, and we'll show you where we're going right now, the technical details, and yeah.
Okay, and I'm not sure if there's a roadmap,
Yes, so we do have a roadmap on that. Also, we've also integrated, and it's almost done, we're going to have our first customer live very soon, the integration of the natural gas optimization, storage optimization model.
Okay. Okay.
We can show the roadmap here.
Yeah. All right. Thank you very much. Hope that answers our question. So we'll move on to mark-to-market position reports. Right.
Slow.
Oh, slow.
So we use a lot of it, but the thing is in our business risk, I mean, we're using it to extract data, really. Right now, we're not as sophisticated to go to Power BI. Our risk users are using some of the market views. We have 10 developed,
Okay.
and they kind of slice and dice, right? And then they pull that out and they build the reports outside the system. But it's been challenging. We generate a lot of those. I know we're partnering up with Essentia. They have some ideas to reduce rows, but one valuation for us can take 1 million rows of data. So sometimes those mark-to-market views kind of very slow. Our risk users just, they complain a lot.
Yeah.
And we didn't leverage the summary report definitions at the beginning because it was non-performant when we did some of the testing, but it got better.
Okay.
So something we're evaluating to kind of in the short term mitigate. But I think what everybody I'm hearing is, get this out, use some Power BI technology to kind of, I think that. But right now, we're trying to leverage those, and we've been struggling. And this is on this transfer.
So just follow up, when you say you pull it out, do you just export it into Excel?
Yeah, so users some of the data to export it. Sometimes they just use it to just view, but at the end of the day, they do an extract and they kind of build outside of the system a lot of their management type reports, dashboards that they want to show the business. Pretty archaic right now we are, but it's evolving, so we want to get to a better place at some point.
Yeah. Okay. Yeah. Thank you. We have.
Quincy with the So, for position reporting, one of the things that I want to mention is we break out our risk and disaggregate it. And we found that there were issues on the power side with doing this. So we ended up having a custom class of it to kind of make sure that it was broken out by the actual index, similar to the way that we have gas natively. I think that would be something that should be that should always be possible within the system. If one commodity can do it, it seems strange that another one can't. I think most people will call it like basis mode versus outright mode. So power wasn't doing basis mode. So we did a class event and that actually worked. We actually worked with Allegro directly to get that done. And now we can disaggregate all of our indexes for power as well as what's native already in gas.
I got it here. Okay, make sure, just a reminder when you guys are talking, don't put the mic too close because it's muffling it for everybody online. If we need to turn the mics up, we can, but don't get too close.
Tom from Essentia. So I was going to maybe do a little dweebish thing on the comment that you just made, but I think it's important for Allegro or Ion to hear this part. Most of the power customers today are designating composites as forwards. That's not supported out of the box due to disaggregation. And that's, I think, what he's describing as the problem. In order to do the things that they want to do with power, to be able to disaggregate from composites as forwards into risk buckets is very important for the power customers in the room. And it's also important for the gas customers because there are differences in the way people think about gas from just the way that exposure type decide works.
So Tom, just to answer that one quickly, we finalized the design of that feature yesterday. We're going to go with Nizar on the technical design in the next couple of weeks, and it's part of the roadmap for the next version. So it's going to be there.
Yeah, because I would agree. I mean, even at, sorry, this is Tiffany with Basin. We did the same thing where we're breaking down all of our prices, our composites. We want to see, particularly gas, we've got NYMEX and then the bases. We can't break it down when it comes to options. Because it doesn't break it before it's hitting the option model, we can't get it out afterwards either. So options are the only thing we've been able to not break down. Yeah, we'd love to hear you talk about an extension on that.
All right, excellent.
Just one thing, I think that's important because we're actually working on the functional design and on the technical design. So any requirements like that, we love to hear it.
Yeah.
So we knew about the composite on a forward, the composite used in the forward mark. We knew about a few of these issues, but we don't have all the details. So I think on the option, that's since we're going to touch the code and change the code, that's the right moment.
And like I said, we can break down all the rest of it. We just can't do it on the options.
Okay, and I'll stress on that. That's part of the reason why we do this, just so we can get issues out and get them to the people who can actually resolve the issues. Sometimes.
That's why Ion is here.
Yeah. So, yeah. Sorry.
Sorry. This is Jack from Zoom. Back here to your right. So on the topic of options, I don't know if it's just the version of 152.2 release, but we've noticed whenever you're out of the money, after the price settles, the description for the price will still float and move. Even after it's out of the money, the value should go to zero. I don't know if that's something that everyone else experienced. I mean, even though it makes no P&L impact, it will say the price is still moving after, it's already expired. And then sometimes if the price moves to where it's back into the money, and that creates a value and it creates all sorts of problems.
I think we fixed that. Now, I don't know in which version. We can check that. Look at me. I think we fixed that. I'm pretty sure. That was clearly a bug. So when you have an expiration date before the expiration date of your underlying, then the price kept floating. That was not right. And as you said, if it's still out of the money, then it doesn't really matter except that it's nasty. But if it gets back in the money, then you have a bigger issue. Now, also in the latest version 145.5, it doesn't do that. But we can look at it for in the next patch for your version.
I'm sorry, which version did you say it's fixed after?
At least in 145.5.5.
Okay, release 5. We're still on 5.2, so I think that might be the reason.
Okay, well, I'll get issues like for all these 2 days, 0 issues. We'll look at it.
So, I don't know if we have someone who's jotting down the issues or making a list of the
We're recording.
We're recording. Okay. So someone will go back and excellent.
That's what council will be doing, Filali.
I'm just trying to get someone else to put it.
I believe you volunteered.
Yeah. Maybe someone else will volunteer to do it. Yeah. All right. Thank you very much. These are very good conversations. So, credit module. So anyone who's using credit. I see a hand over there, a couple hands. Okay. How is that working for you? Good, great. Somehow need some improvement? Maybe?
This is Nick with Invenergy.
Yeah.
So we used to run the credit valuation, and then it just kept taking longer and longer for us to do, and we really loaded up our overnight process with a bunch of stuff. So we got rid of, like, we don't run the credit valuation anymore.
Okay.
But what we do is we just pull down valuation detail. We still have the credit module, so we can have our credit limits in there, and then we calculate the difference between, you know, our credit limit and our exposure, and margin call off that, or expect to see a margin call off of that. And we don't have that history over time, you know, but I'm not really sure it's relevant what my credit exposure was to a counterparty last week. So yeah, that's kind of how we're doing it, just to kind of free up the process in the overnight. It's the same math. We use the module so that we can list the limits. I think it's been working pretty well, you know. We can margin call off of it. It matches the margin calls we get. So yeah, that's kind of my 2 cents on the credit module.
Okay. Thanks.
So we're not using the credit module, but I did have a question, maybe just some comments related to position reporting again and P&L attribution. When it comes to power curves that are on the 2x16s and 5x7s and such, I heard that some people are using composites to break down that type of risk or manage those types of curves. I was just curious to know the most efficient, like who's found the most efficient way, because there's always redundancies when you try to do these types of things if you kind of finagle it, or does Allegro itself in a native way have a productive way of handling it?
Answer? Oh.
So in short, I would say there's not necessarily a, you know, native way. You sort of have to know how to set it up, because as you know, when you get your power actuals in, say that you're doing hourly, you just get a stream of 24 hours of data, right? So as you're tying your actuals to your forwards, and particularly if you're trading some of the ICE financial products and you've got a mix of daily and monthly, that makes it even more complicated. But you know, the most efficient way that we found to do it is to tie your settled, which is a 24-hour string, into an off and on peak by TS period composite, and then tie those composites to, say, an on peak and an off peak ICE forward. If you want to use the BAL mode, then you can tie those to the daily on and off peak, and then tie those as the next forward index to the monthlies. So you make your price tree go from your 24-hour flat settled through a composite to the dailies, through a composite to the monthlies. Just note though that if your traders are trading both the daily and the monthly products, you're going to have a problem with the 2x16 and the 2x8s, because your exchange is going to mark your 2x16 on your Saturdays and Sundays to the peak product. So it gets a little complicated. The functionality itself is out of the box, but you just have to work with it in order to get the right forward mix of prices to tie out with your exchange broker. I'm not sure if that's terribly clear, but that's the best I can explain it.
Yeah, Dawson from Ion. So I would add to that, really it comes down to, I think, understanding from a reporting standpoint, what's the lowest level of granularity. And if you can configure your blocks to really disaggregate all of your transactions, whether you're blowing things out monthly or looking at things daily, as long as you can get those lowest level granularity blocks to break out into the TS periods, you can also do things. I've seen customers set up parent level attributes where you can start grouping together your 2x16, however you structure that across multiple markets, and then give those higher level attributes, so peak, off peak, or other buckets you can roll up, even though you're disaggregating the lowest level with TS queries. But that's really what's your pricing structure. Make sure you can disaggregate the data in the block definitions to that low level, and then you can start adding roll-ups that make more sense from a reporting standpoint as parent attributes. And I would suggest, if you're going to do anything like that, you should start with what you want it to do first. Write that down, get a working example in Excel, and then say, how do we configure this? How do we make this work?
Oh, thank you for that. I actually, once you asked that, I had a question myself, which I'd ask, hopefully someone can answer. It's a pretty straightforward one. So when we do mark-to-market right now, it's probably a configuration, but we only look at the next month forward. We don't look at balance of month. The balance of month calculations are just all over the place. We can't even figure out what price it's using. Like it's just, so we're on the 8th. If you want to look at anything from the 9th, for example, within the month, it's just a mess. So our mark-to-market is always the next month forward. Is anyone doing mark-to-market balance of month forward? Okay.
Yeah, we do even previous months, current months, and forward, but we do the bound. We had some things we had to do on the pricing setup to get it to work to mark realized, unrealized, and but we're using the bound curves. We fit them in, and we're able to run current.
Okay.
And we also provide daily estimates before Platts publishes, and then we had another tweak we had to do there, but we're getting some fixes in. But yeah, we were providing like an estimate because in Horizon there was an issue when you try to put the estimate pricing, or well, we got codes on it, and there's a better way to do it. So we're testing that now. But even the way we're doing it, we got to make it work to run the boundless and all that.
Yeah, this is Jack from Missouri. We also do Belmo, and we had some issues with it previously where the remainder of the month's forward curve didn't average correctly, but through just configuration without any class events, we were able to get the last day settle price and then the remainder of the Belmo month to average correctly by pricing that setup.
Okay, thank you.
Yep. This is Nick with Invenergy. My tip for that is we run a valuation mode that values the month that we're in, but like the power products at the hour, week level that it values, and then like gas is at the daily level. So then you have a clean cutoff of what's the remainder of the month, and that's using the Belmo price, especially when you have a trade that is just used to value the future, and it may not actually settle, and you're not actually settling that trade, but it produces a settlement number. So at a monthly level, it's going to give you the wrong amount. Now, that's also dangerous, not dangerous, but that comes with its own risk too, because if you're going to value your whole portfolio hourly and daily in that month, that 1 month is going to make 20 times the amount of rows that your 7-year out valuation is going to create. So it's a massive amount of data. And so basically what we do is we just purge the last one and just keep one of those in there. That's how we get around it. Now, my risk guy doesn't like that. He wants a little bit of history. But yeah, that's my tip.
Okay, because we have just settlement and then we have the forward. So within the month, we just look at the settlement and we just estimate the balance of month forward and we just move on.
Yes. So one trick I found is that if you set up your Belmo curves as, or your Belmo price indexes as postings, you can actually get that curvature. So like, especially for like power prices and even natural gas, when you're looking at some month, you want to see that curve. That's for the different prices, especially the weekly prices and weekend prices, and that works. And then then you can actually get the disaggregation after the fact into the forward curve pretty well. That's something we're trying.
Okay. Nice. Excellent. Good to know that it's possible. You have to work at it. So I know we skip back and forth a little bit, but that's fine. So anything else Credit module, any?
Yeah, this is Jack from Missouri. Back on credit module. I know not a lot of people actually use this, but we actually was trying to use it for a while. But one thing we noticed is that whenever a trade was invoiced, it dropped out of the forward exposure. So due to that behavior, we couldn't really get it to not drop out. We actually started taking position data, exporting it out, and our VP of Market Risk created a whole new report off of position data. So did anyone else have issues around that? I see a hand over there.
So after all the price volatility we've experienced, last summer I started a big project to clean up all our data to begin using a credit module, and ran into that exact issue. And driving me insane. I was like, what is going on here? Because we would have positions that had yet to be invoiced and they look good, and it wasn't intuitively obvious that that was what was driving it, but that is. And we're also on 5.2, but we're beginning an upgrade here very shortly. And from what I've been told, that is corrected in later versions.
I think I heard 5.5.
I think that's what I've heard as well.
It's a big upgrade where they changed the .NET core, so we've been kind of lingering, but.
So that's to be determined, but that's what we're going for.
Gotcha.
5.2. So just going back, this is probably a technology question as well, but given how often are people upgrading, and if you have an issue that's resolved, is Allegro still providing like fixes before you upgrade? Is that still happening? And Ben?
So what was the exact question?
Exact question is, there's certain issues in some versions that are resolved in other versions, but if people haven't upgraded yet, is there any fix for that in the current version before the upgrade? If, how is that?
Yeah, so we still do it as we've done in the past. So we have the concept of e-patch and maintenance releases. So we actually have a date where we go and release certain version of the code. So I think there's like .3 next month and something else. So we do have that. And in that case, what we do, we actually review the critical issues. So if the column name is not what you want, or you click on the button and does something, we're not going to fix this type of smaller issues. However, the expiration date on the options, for example, that will qualify for a patch. Now, if it's a bigger change, like for example the credit, we've done a lot of work in .5 and .6 on the credit. We cannot backport all of that. And the risk is too big. Or if, for example, to fix it, we need to change the data model and the visual model. We're not doing that either, because again, the changes are too big. You get a patch and then you have your export failing because we have new columns and things like that. So we do not change the data model and visual model on the patches. So yes, we do it, but
it depends.
But it depends.
Okay. All right. Thank you. So hopefully that, if anyone is thinking of, do I have to upgrade to get this? Hopefully that, yeah. Okay. Okay.
Taylor, yes. We implemented credit last year specifically for our Brazil business. They have very simple credit procedures currently, so we're not using all of the functionality. They're not doing any margining or anything like that. But one issue we ran into, kind of similar to the exposure things you guys were talking about, is that I don't know if to Ben's point, I don't know if in all versions of 145, we're in 145.5.4 currently. But we ran into an issue with, you used to have flexibility to configure, so Allegro's credit exposure buckets open, delivered, current, forward. Used to have flexibility with several of those on how you wanted to do the calculation, marked market, intrinsic value, or P times Q. And that has gone away from delivered and current exposure. So at least in our version where it's going to use, you actually have to run settlement first, and it's using the settlement P times Q for that.
So like our current month of Almo, we weren't able to use the mark to market. So our workaround for that was essentially to eliminate current exposure and consider delivered as of, yesterday, where it's using the settlement P times Q, and then forward to essentially begin today. So yeah, just in case anyone else is running into that.
Yeah. No one else? All right, 11:30, we have 15 minutes left. So we'll get into any other business, anything that's not on this list that anyone wants to.
Yeah, I don't know if maybe there's another session for this, but with respect to FERC 552 reporting, in the native Allegro, we've tried a lot to make sure that the information we're reporting to the government is accurate, and it doesn't seem that Allegro does that natively very well. There's a few little things that we've noticed, so we've actually had to export all of the data and put it into Excel and manually calculate things like trades that were done, next day trades that fall on a weekend, or other types of meets and nets that aren't really behaving properly in the Allegro. So it's something that is, as an ETI, we all get the data. We're encouraged to put the data in the system, and we have to report this type of stuff. It seems like this would be something that maybe more of a priority for most of us when it comes to looking at what needs to be fixed.
So we use, Stephanie with Basin again, we use the FERC 552 out of Allegro. It took a lot of configuration, our parameters, things like that to make sure that we got it right. And we do use it, but we absolutely check it. So we'll run, we'll dump data out of trade execution that is basically grabbing all that manual data, and we do a comparison to what's coming through on that FERC 552. And I would say it's probably about 95% accurate when we've done it. Randomly, we'll have a trade pop in, no idea why it's there. Randomly, one's not there. But again, I would say it's about 95% accurate. So it could just be in how you're using it or the parameters of such. I'm not saying there isn't quirks with it, because there definitely is. It could use some attention, but it's better than what it used to be. So.
Thank you.
Yeah. Yeah, and I can add my own experience where we do the same thing. I just did that, I think, a month ago. We export everything and just scrub through the data, and part of it is data quality that we found. So, some of the fields, we have trade class for next day, next month. Sometimes they don't fill them incorrectly. So if you just put that out, your data will be wrong. So we go through scrub, have formulas looking, okay, trade date versus flow date. Is this really next day? Is this really, So part of it is data quality. But for us to run those things, we do it once a year. So let's just do it and move on, kind of thing. So, yeah, but it does need some attention. We just haven't had the resources to pour into it for how often we have to do it.
Hi, this is Jack from Missouri. Just one question for those of us that do nat gas. Has anyone else had challenges with pipeline fees going to the position settlement valuation correctly? I'm referring to, your fuel loss, your ACA, your demand, your commodity, all the fees flowing correctly all the way through.
Yeah, I think that's probably a standard issue. And we will address those conversations this afternoon in the nat gas session.
Oh, okay. All right. Good deal. Good deal.
Anything else? Anything else for risk? We have 10 minutes.
Any other risk heartburns? Any risk success stories? Let's share both. Success stories are great for all of us to hear too.
Tiffany, anyone online or any comments from online?
I don't think so right now.
This is just something I want any users of VAR to be aware of in the, 145 I guess somewhere between the 2 and the 5 range. If you are running your VAR and correlation and ION is aware of this and able to help with a patch. But if you're seeing 0 correlations show up and it's just seriously showing 0 correlations, check the cleanliness of your price feeds, because we have had experience with if the price history, especially if you're using a UMA factor and you don't have a clean price feed in the look back, you could have an experience of it throwing 0 correlations, even if it's just missing one price. And depending on if you have just a ton of curves, you may not realize you have a gap in some of your prices. And it can also cause performance problems in your overnight batch. So it takes some digging to find, but certainly the reinstatement of, in the later versions of an interpolation of prices to prevent that. The later versions of 1.5 is a help because we don't always have perfect price feeds. It's a great thing to aspire to. But for those using VAR and correlations, especially on a frequent basis, that's something to watch out for.
Excellent. Thanks for sharing that.
I'm not sure what this question actually is, but it says applied volatility extrapolation functionality. Question mark. Oh. Allegro does not extrapolate implied volatility data to include strike prices that are beyond the range of strikes available from market data providers. We've been told this is not part of design, even though the interface includes the buttons.
Oh.
Scott, you know the answer. We spoke last week about this. So it's actually an enhancement. It was designed to be there, but it was never developed, so there is no code behind that functionality. So if that's also something that other customer wants, then we're happy to hear and we'll consider it for future enhancements.
Raise your hand if you'd like that as an enhancement.
I raise my hand.
Implied volatility outside the published strike price. I mean, it can be. So you'll not find that on the WTI or in TI. You have strikes all across the place, same as NYMEX New Hill and all the others. But on more illiquid prices, it can happen. So it's a valid request. In that case, we're working directly with the customer. We're also looking at a potential extension, but we're also open to enhancements if other customers want it.
I was just going to offer a really small data fix you can do, which is if you're interested in doing something at either end, to put in the call for a tick or whatever the minimum option price is, or a put for the minimum option price at that endpoint, the service will fill in and interpolate. Extrapolate, then kind of raise, well, why would you extrapolate? If it's not there, it's because options, there's no open interest there. But if you're interested in just building a complete surface, feeding in that min price to create the endpoint and let it interpolate is just fine, and the service will fill in for you.
This is really more of a settlements question, but receivable invoices and payable invoices, they have the same ID. Is there a way that we can make it so those two IDs are unique? Can we do that, or do we have to live with that?
Okay.
So that was an issue for us in terms of interfacing to accounting. Interfaces are looking for a document number. Okay, well now we've got two of the same, et cetera, et cetera. We just ended up making our queries on the interfaces smarter to account for that. That was the only way we figured out how to do that, but.
So is this when maybe you have counterparties who are not netting the amount, they want a separate payable and a receivable invoice? Is that the question?
No, so DB SysGen has separate values for AP and AR. It goes to create an invoice. So when it gets, you can have the same invoice number that's an AP item and an AR item, is what he's saying.
I see.
We got around that because in our interface, we use FinTransact as the key between the system. So in SAP, it's a unique number. It's a unique number. In Allegro, we don't even use the invoice number. So
I see. Okay.
Yeah, it's just, we're putting that ID on our paper or PDF copies of it. So when an auditor wants to look that ID up in the GL, they have to, like, we're kind of stuck with that number. But I like that idea about, like, you know, when we load it to our GL, just put like AP on the end of it. Although the system won't, Allegro won't have that. It will just be a clean load. Yeah.
Yeah, one thing I've seen some customers do is if you're able to do it, you can set the ID high enough where you're never going to overlap between the AP and the AR as separate counters, or expand the field so that you can do that, because it's really more of just an informational field that's not really used as the primary linking element. And then I suppose you could probably also set up a minor class event to increment both every time either AP or AR is created. But that's the trick I've seen most often is just setting them far enough apart that you never actually overlap.
Thank you. This is why we do this, right? Any other questions, suggestions? Someone said feel good stories. Any success stories? There we go.
This is Steve from McHolden. In our version, we are using the FinTransact number as the gentleman in front of me is using. We pass that along to our GL accounting system, and then we bring that back when cash is applied. So that's the mapping for it. You know, one of our needs were on the AP side to capture the vendor invoice number versus just using an auto incremented number from Allegro. It doesn't really serve the purpose. So, you know, we had some issues where our users are going to type in that vendor number and you can have duplicates, and then our GL system won't allow it. It'll kick back if you have a duplicate document number. So the FinTransact kind of is the better of the two animals, I think, in the long run. And then to just sort of hope that you don't do 10,000 invoices in that particular time range, or depends on your model.
Yeah, sounds great. Thank you. All right, 3 more minutes. This is your last chance. 3 minutes. Going once. Going twice. All right, thank you very much. I think this was a successful risk session. Thanks. Thanks, Tom, for presentation on PFE, and just reminder that the next session there'll be another draw.
Yep, at 1 p.m. Be in the room. It's a pretty good draw, and if you're not in the room, you cannot win. We just gave out $150. You weren't here. So we're going to start back. There is lunch in the same place breakfast was. Please help yourself and mingle. No.